All right. I want to say welcome to everyone to today's webinar. Will multifamily thrive in 2025? I'm personally really excited for this webinar. Part of the reason I'm so excited is our first webinar of 2025. If you're joining us here tonight, we had quite the number of people, almost 100 people registered for today. So apparently, there's a lot of people that are very interested in multifamily in 2025, but they're also very curious of where we stand here at Headway Capital based on what's going on in the market, right? What we have a new president, so we're going to talk about that a little bit. But regardless of that, we have a lot of data in the market, a lot of things that we can now look back on with 2024 being behind us and start to make some educated decisions on what we think is best in 2025. And we're going to discuss tonight, on our opinion, do we think multifamily will thrive in 2025? So excited that everyone's here. If you have any questions along the way, please drop them in the Q&A box. I will do my very best to answer them at the very end. Let me pull that up here to make sure that I have it. Very Q&A. Perfect. All right. I think we are ready to rock and roll. So let's go ahead and get started. If you want these slides, shoot us a text. Just say, hey, Brian, shoot me these slides at 281-559-7061. I'll get these slides right over to you. As a quick disclaimer, this webinar is for educational purposes only and should not be considered legal investment advice. This is just our analysis of what's going on in the market and our opinion on what we think is going to happen. As usual, we always recommend that you consult with your attorney, financial advisor, CPA for any legal matters or recommendations on investments. A little bit about us. If you've never been here before, you've never attended one of our webinars, I want to say welcome. Thank you for attending. Our company, our firm, Headway Capital Investments, was created to help build and protect the wealth of busy professionals by using commercial real estate with a focus on multifamily, with a focus on apartments. So our goal is to provide cash flow, equity appreciation, and tax benefits from these investments. And we have a lot of experience doing it over the last 7 years now, which is crazy. Somebody had asked what the number was, so I'll put it on your screen one more time at 281-559-7061. So I'll go ahead and put it in the chat as well. And there we go. Perfect. A little bit about us. These are some examples of some quality assets that we own here in Houston, Texas. We have a little over 450 million of assets under management, which is crazy. A little over 3,000 units as well. And our target focus is to provide 25 to 30% average annualized return once the project's all said and done. And we have over 500 active partners that have partnered with us in the past. And you can see some of their testimonials here from partnering with us in the past. So always really excited that we have raving fans, so to speak, people that love working with us along the way. Some other examples of some deals that we've done here. You'll see 3 assets here. I need to update this slide. We've got a couple of assets that we bought last year that I think would make good for conversation, but we've got some assets here on the screens, 2 newer assets that are newer vintage, I should say, and 1 older asset here in Watermill. Tomorrow, we are actually conducting a property tour at one of these assets that you see on your screen. So if you're here in Houston and you want to dive a little bit deeper onto some of the acquisitions that we've done in the past, learn a little bit more about how to be successful as a multifamily real estate investor, shoot me an email. I have my contact information at the end. We have monthly events and quarterly events as well. And to kick off the year tomorrow at 10 a.m., we are doing a case study at an office in Sugar Land, and we'll go to the property that we're doing a case study on right afterwards. So I'd love to have you there. So let's dive right in. Will multifamily thrive in 2025? And let's go ahead and talk about I'm going to go ahead and put the link in there for you, Philip. So I saw your comment. I'll show the link for the property tour. Somebody had asked about that. So I'll go ahead and put that. So will multifamily thrive in 2025? This is something a lot of people have asked me about. Well, what's my opinion on the market? Do I think it's going to be a good year? Do I think it's going to be a rocky year? Do I think it's going to be a bad year? Go ahead and put that there. Just put that in the chat, Philip, if you can make it. Let's talk about that. Let's dive right in. But let's talk about the elephant in the room. We can't do this without talking about the economy, right? We have to understand what's going on in the economy if we're going to make educated decisions and we're going to try to buy smart investments, right? So the presidential inauguration happened 3 days ago. If you didn't know, you're probably living under a rock, but President Trump retook office as our next president for the next 4 years on the 20th, this past Monday, during our preparation for Snowmageddon here in Houston. And he's already started waving the magic pen and signing all kinds of things to undo some policies that were done by previous administrations, but also to enact some new policies that he feel is going to improve, that he personally believes will improve the economy. So time will tell, but we have some changes coming along the way. What those changes are, we don't quite know yet, but a lot of people are very bullish, right? So looking at some of the market indicators, this is something that I always recommend that investors look at. Not because I am all in on equities, but the equities market is a great testament to what's going on as far as investor sentiment when it comes to investing, right? So the S&P, these are two screenshots for from some popular websites that talk a little bit about investing in business. The S&P 500 hits a record high as Trump tariff threats to fail to spook markets. So even though he's threatening tariffs, the S&P 500 has been growing really strong. The stock market today, Netflix and AI excitement sends Wall Street to the brink of an all-time high, right? So we're still seeing really strong growth in the equities market, and we're also seeing really bullish growth in the Bitcoin, the crypto market, right? So even if you're not into that, the markets are responding, that they're excited that a new president is in a seat. He's saying things that are getting people excited about making money and the economy overall. So we're seeing that today. I don't know what it ended at. Well, the market doesn't close crypto, but when I checked it earlier, the screenshots from earlier today, it was around almost $106,000, which is up from, as you can see, from the previous week before that. So everything's very bullish. People are very excited. The one thing that has not seemed to reflect the fact that we've seen rate cuts is the treasury. So if you're a real estate investor and you're not keeping an eye on the let me rephrase, if you're a commercial real estate investor in particular, and you're not keeping an eye on the treasuries, you're doing yourself a disservice, because the treasuries are a large indicator of what our interest rates are going to be if we go out and borrow money, take a loan from the bank for a deal, right? So the markets are typically, our assets are typically based on, and our loans for our assets, excuse me, are typically based on the treasury. So the big one that everyone likes to look at is the 10-year treasury. As far as kind of measuring the economy, we also look at the 3-year and the 5-year, because our loans are typically, we don't always take 10 years loans, right? Sometimes we take a 3-year loan, sometimes we take 5-year loans. So we're always looking at the treasuries to see where they're at. But this is a screenshot from the Marcus and Millichap report that they put out, or update that they put out last week. And you'll see here the 10-year treasury reached 4.8 in the third week of January 2025. So even though we've seen rate cuts since the beginning of January, we've seen a 20 basis point increase in the treasuries, which means if you go out and borrow money for commercial real estate, you're going to spend more money on your loan. So it's been very interesting to see. And a lot of people have a lot of theories about why the market is sort of doing the opposite of what the Fed is doing, right? So the Fed is cutting interest rates to try to because they believe inflation is going down and they want to make the economy more accessible, right? But the market is saying that they're not quite sure inflation is done yet, so treasuries are still going up, right? So as far as supply and demand goes, people are still showing that they're a little bit, I would say bearish, but they're not quite sure if inflation's done yet, right? So the treasuries are still continuing to grow on a daily basis, which is, I don't think personally that that's going to continue to happen. I think we're going to see the treasuries be pretty rocky, potentially for the first quarter, but we'll start to see some stabilization going into quarter two, if not the second half of the year. With that being said, you can't talk about treasuries without talking about inflation, right? So these are some updated charts as of the latest data that came out in December of 2024. So you can see here the U.S. Consumer Price Index, which is also known as a CPI. So you see a year-over-year change on your left and a month-over-month change on your right. And you can see, regardless of all the headlines, depending on where you like to read your news or where you listen to your news or who you talk to, some people have sort of a bearish sentiment sometimes. They may say, oh, inflation's growing, it's not slowing down. Well, I like to pull up one of these charts and show them, like, let's take a look at what inflation was 18 months ago, even 12 months ago, right? 18 months ago, inflation was over 9%, right? So the CPI index was over 9%, right? For all items. Now we're at 2.9 as of the latest reading that came out a few weeks ago, right? So that's a drop. Now, is it falling off a cliff all the way to the 2% growth that the Fed wants? No. But we now have the baseline effect, right? We're comparing year over year data. So the market is showing us that inflation is still slowing. We are still seeing progress. It's just that getting to that last 2% historically has always been the hardest part. It's easy to go from 9 to 7 to 5 to where we're at now. It's very hard to go from 3 to 2. That's the hardest heavy lifting part. So I'm not surprised to see that that's been a little bit of a struggle. And then you'll see the month over month growth here on the right as change. month-over-month percent change as well. So again, it's really important to note with all the CPI data that we're seeing, one of the notes that I wanted to highlight is shelter prices. That is a big component of CPI, about 1/3% of the weight to be exact. Rose 0.3%, but we're up 4.6% from a year ago, the smallest one-year gain since January 2020. So a big reason we're still seeing CPI headlines be high, or people saying inflation is still high, has to do with the fact that shelter costs are still very high, which we're going to talk more about that today, and how, in our opinion, that's actually a good thing, because if people cannot afford to go out and buy a home, whether it's due to pricing or interest rates, they're sort of becoming renters by choice, renters by necessity, I should say, versus renters by choice, right? So really important note to measure. Another important thing I like to highlight when it comes to looking at economics is wage growth versus inflation, right? A lot of people often get concerned when inflation's really high that potentially it gets harder to push rents. And it does. It definitely does get harder to push rents when when inflation is high, right? Because people are spending more money to buy the same stuff. But the one thing I do want to highlight, and this chart does a really good job of showing it, is that the year-over-year wage growth is above inflation right now. We went through a period, a pocket that was very painful, right? You see where these gray bars, which is year-over-year inflation, was way above year-over-year wage growth. So even though coming out of COVID, everyone felt like they got a massive pay raise if you were in corporate America, or maybe you were trading jobs for big, 10, 20, 30, 40, 50% salary increases, that obviously still was not enough, because inflation was super, super high. We talked about it touching 9%, right? 18 months ago. Well, look at where we're at now, right? Look at Q2 and Q3 of 2024. We've still seen a really strong year-over-year wage growth, but inflation has dropped, right? So is wage growth as strong as it was 2 years ago? No. But we're still seeing positive wage growth, which is good, because that means people can afford rent increases. They can afford to live in a nicer place, which is why we've seen a lot of absorption in A-class product in particular. So we'll talk more about that here shortly. Jobs and unemployment, right? This is another economic data point that we like to discuss. That's really important to look at if you're making investment decisions as well, because our residents need jobs in order to pay their rent, right? If they don't have job stability, collections become hard, evictions go up, and it gets hard to improve your rents as well, right? So this is the latest data, again, that came out recently from December of 2024, right? So we've seen a lot of headlines saying how amazing job growth has happened, right? We saw 256,000 jobs created in December of 2024. That was significantly above I believe it was 155,000 forecasts that the government was forecasting. So they forecasted there would be 155,000 jobs created in December of 2024, and the report actually came out and said it was 256. So that's a big improvement over what they forecasted, right? So according to the data, now the job growth numbers sometimes get edited in arrears, so they'll go back, in February they'll come back and say, oh, these are the actual numbers. The one we released 30 days ago was actually wrong. Here's what it really was, and it kind of goes under the radar. Nobody really talks about it, but regardless, this is still a really strong job number to see a print on, right? Which is good. And then you see on the right hand side the U.S. unemployment rate. We want to really pay attention to that 4% mark, because once it starts getting above 4%, the Fed goes on alert. And if it gets above that 4.2, 4.3, starts creeping towards 5%, that sends off sirens for the Fed, because the Fed's job is to make sure we have employment stability in the United States. And if we start creeping up towards 5% of unemployment, it could potentially force their hand for additional rate cuts, even if we have inflation, right? So that's a really tricky position to be in. We're not there yet, and it theoretically could happen, right? Where inflation were to continue to grow. We're not seeing growing inflation right now, but let's say, for example, inflation decided to continue to tick up due to all the strong economic data we're talking about today, including wage growth. And we saw unemployment go up, right? That would be a tricky situation to be in, because if they're supposed to ensure that jobs are strong in the United States economy and they cut rates, that's gonna be a really tough position to be in, because cutting rates usually leads to an increase in inflation, right? So it's definitely something to keep an eye on. So I'm always watching the job data, and you should be too as an investor. So what does all this mean for multifamily? What is unemployment? What is wage growth? What is the CPI print? What is Trump being in the office? What do these things mean for multifamily? And do we think multifamily will thrive in 2025? Well, let's look at some of the data now that the year is over, right? We've 2024 is in the books. It's January now. What did we see last year, and what are we sort of seeing in the forecasts? All the big firms now, Colliers, Marcus and Millichap, JLL, all the firms have put out their sort of 2025 forecasts and their summary of what happened in 2024. So let's look at that now and make some determinations on what we think might happen in 2025. So this is from Marcus and Millichap on one of their weekly updates that I like to watch. And the update says the supply-demand outlook for most types of commercial real estate remains positive, with demand strengthening and the pace of supply additions slowing. So this is something that's really exciting. We're going to talk quite a bit about this. Is we are seeing the pace of supply slowing. So that's just kind of a fancy way of saying less new construction multifamily apartments are being granted, permits are being granted at this point. Not people are slowing down the building, right? So the last few years, we've seen a record-breaking amount of deliveries, which is a fancy term we use for new construction apartments hitting the market in the United States. And Dallas, Houston are usually somewhere in the top 3, top 5. Dallas is almost always number 1. Houston often number 2, number 3 in the amount of deliveries that we are receiving, right? So a lot of new supply hitting the market. Well, what happens when new supply hits the market? That pushes down rents because there's all these new fancy units on board, and that impacts the B-class assets, and it even impacts the C-class assets because these new construction apartments often offer concessions to get people in the door. They're doing 30 days free, waiving your application fee, discounted rent for your entire lease, just so they can fill up the new property. Nobody wants to build something and it sits empty, right? They need to fill it up so they can either refinance out of their construction loan and put a more long-term fixed rate debt on it, or they can sell it, right? And in order to sell it, if the buyer wants stabilized, agency debt, they need to have the property 90% occupied to get there, right? So they're looking to fill the apartment up very quickly. Well, when they have a lot of new deliveries, that pushes rents down, right? Well, when there aren't not a lot new deliveries, you have the opposite happen. The absorption gets really, especially if there's strong demand, absorption gets picked up, all the units get absorbed, and it starts to lead to rent increasing because there aren't enough units due to the demand. So we're going to talk a little bit more about that today, but it's really exciting to hear from Marcus and Millichap that they see the same thing that we're seeing here. So let's talk a little bit about transactional activity from the last year, right? So last year, and this data is from Q3, so it's missing Q4, but last year, a lot of people said the market will slow, right? Well, this chart is very telling about what actually happened last year. So, of course, did we see a year like 2021 in the first half of 2022? No. But last year, as of Q3 data, the market was still pretty in line with what was going on in 2015 and 2016, slightly below 17, 18, but definitely above years prior to that. I mean, look at the last 24 years. So now, obviously, going after 2008, 2009 saw a massive dip due to the great financial crisis, right? Everybody remembers the recession from then. But 63,000 units, 63,000 transactions, it's still a really strong number, right? And this is for all sectors, right? This isn't just apartments. This is retail, this is office, this is industrial, and this is any asset that equals $1 million or more. So still pretty strong activity in 2024. Was it a record-breaking year for transactions? No, but I don't think we'll ever see the type of transactional volume, at least in the near future, that we saw in 2021 and 2022, but still a really strong year. Multifamily deliveries, right? This is something that's really, really important to understand when you're thinking about the long-term outlook of your investment, right? So when we're buying these deals, we're buying multifamily assets. Typically, at least here at Headway, our deals are typically 3 years or 5 years, and they could potentially go longer, but we typically model on a 3 or 5 year term. So why are deliveries important? Well, I kind of just talked about it a few minutes ago and alluded to it. If we see a slowdown in deliveries, that's going to help increase asset valuations because there's not a lot of new product on the market, and it's going to help increase rents. So we're going to see cap rate compression and we're going to see rent growth. That's the double whammy. That's where you can make a lot of money because the market is really in your favor, right? So let's take a look at this chart, which shows multifamily starts trailed completions by historic pace of 2024. So it shows the multifamily unit starts minus completed, right? So we see here in 2024, 254,100 more units completed than started in 2024. It was the first year where we actually saw a negative number for quite a long time. You have to go all the way back to the great financial crisis, right? So we saw a massive drop in the amount of completions in 2024, and we expect to see another drop in 2025, right? So there are less units hitting the market compared to what was actually started. Part of that could do with construction issues. It could do with financing issues. It could do with permitting issues. It could do with all kinds of things. But we saw 254,000 units completed, then started in 2024. So did another thing I'd like to talk about too, because some people may be looking at some headlines, and I saw some headlines too as well saying a multifamily construction surged in December 2024. Well, not really. What's important to really look at is the trailing 12 months of data, not always just the seasonally adjusted number here. So this chart shows that. Now, seasonally adjusted, we saw an increase in permits in December of 2024. Yes. But looking at the trailing 12 months data, it's not seasonally adjusted. We saw the numbers were actually relatively normal, right? So we haven't seen an increase in multifamily starts. We've actually seen a decrease, right? So you're looking at this chart, looking over, of course, coming out of COVID, we saw a massive increase in multifamily starts. Debt was cheap. Money was not free, but pretty close. And everybody wanted to buy and build multifamily. So we saw that. Well, all those deals that got started in 2022, 2021, they hit the market in 23 and 24, and some will hit the market next year. But we're now seeing that decline, right? So we're seeing that decline in starts going into 2025. And this chart here, I think, is probably the best chart that I found on showing the multifamily apartment units that are underway in specific cities. So these are apartments. These are apartments that were built, and then these are forecasting what is expected to be delivered going forward. So I want to spend some time talking about Houston because we are in Houston, and a lot of our deals here that we're looking for in Houston. Let's start with 2023. In 2023, if you look at the chart here for Houston, we saw 60,000 units delivered in the city of Houston. Well, go back one more year. Last year was about 40,000. And then the forecast for 2025 is right below 20,000, right? So you can see that we are seeing a massive drop off in the amount of units being delivered over the last few years. And again, that is going to lead to asset valuation. It's going to lead to absorption because we do see a lot of strong demand, which we're going to talk about here in a second and why. And it's going to lead to the ability for us to push rents, which is why our rent growth forecasts by all these different providers is very strong for next year compared to 2024, right? So this chart is very telling. So if you're an investor and you're partnering with us, we're very bullish on Houston. We're going to continue to buy deals in Houston. We're also looking in other markets like Dallas, for example. Dallas is a great market, a very strong appreciation market, less cash flow, but very strong appreciation market. And you'll see here, I mean, Dallas was insane in 2023, over 100,000 units were delivered in 2023. Then, of course, you saw the slowdown in 24, but still really strong. 25 is expected to be in the low 40s. And then beyond that, there's a massive drop off in permits, right? So really interesting to see. The other number that I do want to highlight is the percentage of the market that are new construction. Dallas, where there's a little bit of risk involved compared to Houston, is a very large percentage of their market is new construction. There's been a ton of building there for many, many, many years, and a lot of the assets are very new, which isn't necessarily a bad thing, but it adds a little bit of execution risk because a lot of the apartments are new. You compare that to Houston, for example. So they've got about, right, if you're looking up here, a very large amount of number. It's a percentage of the market. If you're looking at this chart here, it's between 10 and 15%. So call it 12.5% of the market are new construction assets. Well, looking over here at Houston, less than 10% of the market are new construction assets. Now, that's not a huge delta. Call it a 2.5 to 3% delta, but it makes a big difference when you're looking to buy either existing value add multifamily, so Class C or Class B product, or you're looking at A-class product. And we like A-class product. We're hoping to buy at least one A-class deal this year. You want to look around and see how much of the market is your competition, because an A-class property does not compete with a C-class property for the same residence. We need to compare apples to apples, right? So if a large part of the market is all A-class, then you have to look at that and really weigh what type of impact is that going to have in your ability to push rents. How much concessions are you going to have to give? You're looking over at your neighbors to the left. They've got 1 month free and $100 off. You're looking over to your neighbors to your right. They've got 2 months free and $200 off. So you have to sort of look around to those types of things. So it's really important to understand how much new construction is going on in the market, how much of the total market is new construction, and where is the market going? Is it continuing to build, which can impact your ability to push rents, or is it actually slowing down, which can actually positively impact your ability to push rents? So really, really strong chart here. This was probably my favorite chart I found on the subject matter. With that being said, we talked a lot about new deliveries. We talked about new construction coming on in Houston, coming in Dallas. There's just some other charts here that really important. I don't think I see San Antonio in here. But some really strong markets that are really good markets to invest in. But let's talk a little bit about supply and demand. Building apartments is great, but is there actually demand for those assets? Well, I'm here to tell you the answer is yes. So this chart here is from a report that RealPage, which is a big a company that puts out a lot of both residential and commercial real estate data. This is their chart for the year end December 2024. And the two numbers, or a few numbers that I really want to highlight, are 2024 year rent growth for the nation. This is not just for Houston, with about 0.5%. I've seen some different numbers. One provider put out 0.4, one provider put out 0.5. It's tomatoes. We're talking about 10 basis points there, but call it about 0.5%. So we saw about 0.5% rent growth nationwide in the U.S. last year. So that's not a huge number, right? I like to call that flat. It's really not a huge number. You can see here the average effective rent and then monthly effective rent change. There was a little bit of a negative number there, right? But the thing we're talking about today is supply and demand, because we're trying to answer the question here: will multifamily thrive in 2025 and beyond? So we're still talking about supply and demand. The one thing that I want to highlight here is that there were 588,000, call it almost 600,000 units supplied for the year in 2024. Well, the amount of units that were actually absorbed in 2024 was actually 666,000. This is one of the first years in a long time that we've actually seen positive net absorption in the multifamily space. So 588,000 units were delivered, 666,000 were absorbed. So that's going to mean that there was a lot of positive absorption from assets that were built prior to 2024, right? So that's a really, really strong number. And you can see here at the bottom, the quarterly supply units just for quarter four was 155,000. And then the quarterly demand for those units was 230, right? So demand is exceeding supply is the message that I'm trying to get across here, right? And you can see the average occupancy across the U.S. as well. The Northeast saw really strong demand for multifamily, and part of that has to do with some immigration policies from last year. Everybody saw the headlines about a lot of migrants getting shipped to the Northeast, for example. So that helped with a lot of demand for multifamily assets. And then, of course, you've got the South, which is where we're at, the West, and then the Midwest. So really strong numbers here. So again, demand outpaces supply for the first time in over 2 years, right? So this chart here, again, is very telling. So the line you really want to look at is this sort of bluish, blackish line here. Again, this is from RealPage. We're seeing this number above zero, right? So you've got your annual supply in green, and then you've got your demand in orange. And you'll see this has not happened since mid-2022, where the line was above zero, right? So this is a really good sign. We went all these years, 2011, 2013, 14, 15, 16, 17, where we were actually building more apartments than people were actually demanding. And part of that was because interest rates were low, the economy wasn't restrictive, it wasn't hard to buy a house. There's a lot of things sort of making it easy to get into, whether you're in residential real estate or commercial real estate. So we were actually building more than people were demanding. That is no longer the case. We are not building enough, is the message I'm trying to get across here as far as the latest data goes. So this is demand outpacing supply, which we just haven't seen in a couple of years, which is a really good sign if you are in the apartment space, right? So let's talk a little bit about the supply leaders and the demand leaders that we saw from last year as well. So Dallas and Houston are two markets I want to point out. So we are obviously based in Houston. We talked about the 600,000, right? We talked about this big number here, but how much of that was actually Houston? So 25,000 of those units were from Houston, and almost 6,000 of them came just in Q4. So we had 25,000 units supplied in 2024. How many were actually absorbed? How many were actually rented? 31,925, right? So we saw, again, positive net absorption. We want to see positive net absorption. It's not bad if it's negative, but it just shows you that there's a ton of demand, particularly for newer assets. People are looking for the A-class assets. They can't afford to buy a home. We'll talk about that here in a second. So they're going to nice, safe, affordable, newer assets. So we're seeing really strong demand for multifamily in a variety of markets, including Houston. Dallas, you're going to see the same thing. 35,423 units delivered last year. 36,724 units were actually absorbed. So again, they had positive net absorption as well. So really strong, really great to see Houston and Dallas in the top 5 here, with Dallas and Houston actually being number 1 and number 2 in demand. So a ton of demand for multifamily here in Dallas, in Texas, and then of course in Houston. So let's talk a little bit about 2025. What are we seeing when it comes to apartment supply and deliveries going into this year? We've been talking a lot about what we've seen, but what's going to happen this year? So these are all forecasts that are, of course, what actually could happen could be very different. But according to RealPage, you'll see here in yellow across the U.S. in some major markets the amount of units that are expected to be delivered, and then the inventory growth calendar, so the total percentage of units that is, right? So in Houston, we're expected to see 14,619 units delivered in 2025, which is still a really high number, right? But let's compare that to what we saw last year. In Houston last year, we had 25,000 units delivered, right? So from 25 to 14, that's a drop in deliveries, right? Let's look at Dallas. Dallas, again, still really strong, is expected to have 26,923 units supplied in 2025. Well, looking at last year, they had 35,423 units. So they went from 35 to 26. Again, about a 9,000 unit delta. Again, we are expected to see positive net absorption in both Dallas and Houston, which should lead to strong rent growth, which we're going to talk about here in a second. But before we talk about forecasted rent growth, what actually happened last year with rent growth? So last year, again, we talked about it. We saw a 0.5% annualized rent growth. And the one thing that I do want to highlight is that even though rent growth is slowing or slowed compared to 2021, 2022, things are actually improving, right? So you'll see here, again, this is from RealPage, you'll see the rent growth in green in 2023, and then you'll see the rent growth in 2024 in blue, and you'll see anything below 0 is obviously negative. So it's very common at the end of the year that rent growth slows down. Everyone knows nobody likes moving when the holidays are here. Nobody wants to be packing their stuff up before Thanksgiving and moving the kids before Christmas. Really, the prime leasing season in the multifamily space is really in the summer, right? So it's not uncommon that we see low or flat or slightly negative rent growth in the Q3, into Q3, beginning of Q4 of the year. So nothing to be alarmed about. But what is encouraging is that number actually shrunk compared to 2023, right? So in 2023, looking at October, right, Q4, we saw a negative 0.18. This is actually the delta. We saw negative 0.5% rent growth, so negative 0.5% rent growth. And in Q4, we saw negative 0.4. So that's an improvement. Same thing, we saw negative 0.5 here. And then again, it looks like it's slightly improved to negative 0.4. So again, the number is showing that we're still seeing positive improvements compared over 2023. And you can see the difference between them here. The number is shrinking, right? So again, a good sign when it comes to rent growth, looking at 2023 compared to 2024. But what are the rent forecasts for 2025? What are we expected to see? Again, this is from RealPage, and I went also and found this is a great chart from our friends over at Headway Capital. They have a chart of where the different groups are putting rent forecasts. You'll see here some markets here, and again, I do want to highlight the markets that we like to focus on. So here we are, Houston is right here in the middle of the screen. I'm circling in blue. We are expected to see similar to national average of 2.5% rent growth. So we are forecasting a 2.5% organic rent growth in Houston, Texas. Organic means the market is growing. We don't have to do very much to get that. It's organic. Now, In our industry, there's also something called forced rent growth, meaning we are renovating units and we're pushing rents, right? That's much different than organic, because if you buy an asset that has been owned by the same owner for 30 years and the rents are $700 when the market is $1,200, well, you're going to get way more than 2.5%, right? When you go and you renovate that unit, you're not getting 700, you're not even getting 1,000, you're probably getting closer to that 1,200. That's way more than 2.5%. That's forced rent growth. This is organic, just the market growing, rising tides sort of lift all boats based on what's going on in the economy. Houston is on the list, according to RealPage, should be forecasted to expect about a 2.5% rent growth last year, or this 2024, I should say. Again, it was pretty close to flat. I believe I should have put a chart on here. I think it was around 1.6, 1.5% rent growth. So we're expecting to see more rent growth this year in 2025. You'll also see Dallas, really interestingly enough, is Dallas is actually expected to have growth below the national average, right? So if the national average is 2.5%, they're expected to be slightly below that. And partially, in my belief, that is because of the amount of let me delete all these clear drawings. This is due to the amount of deliveries that they've had, record-breaking amount of deliveries over the last several years. So last year they had 35,000. Even though it was positively absorbed, they're still building a lot of units. Dallas is very popular for new construction, and that's gonna sort of hinder the ability to push rents, right? When you have a lot of new deliveries, it's hard to push rents. Well, Houston is slowing down, just like Dallas and all the other markets are, but the number is much smaller, 14,000 deliveries compared to Houston delivering 25,000. So that's why we're able to see stronger rent growth as well. So it's one of the factors, I should say. So rent growth predictions for 2025. RealPage is predicting about a 2.5%, right? CBRE, which is a big multifamily brokerage, they do investment sales. They also provide debt and equity for deals. They also do a lot of multifamily research and provide a lot of a market analysis on what's going on. They're a great firm to work with. We've partnered with them on a lot of deals. They're predicting about a 2.6% rent growth nationally as well. CoStar is a big company that does a lot of multifamily data. They provide data services where you can actually buy a CoStar subscription and get a lot of market data on what's going on, both hyper-local in your city and your state, and then, of course, nationally. They're predicting 3.5%. So they're a little bit more bullish, I should say. And then RealPage, which is a company we're talking about today, they're expecting it to be about 2.8%. So again, the good news is we're seeing much larger numbers compared to the 0.5% that we actually saw last year. So we're very bullish overall on multifamily. We're going to talk about that over in our recap. So, and again, why is this important? And why is rent growth important? Part of the reason rent growth is important and why we're bullish is, again, this is a chart. It has data from Q3. I was not able to pull the Q4 data yet. I wasn't able to find it, but this is something I think we're all very aware of because we see friends and family living and breathing this on a daily basis. The cost to buy a home is substantial, right? It says here, year over year, the spread between home ownership and rental costs increased 7.6%, reaching $1,203 in the third quarter of 24. Elevated by record high interest rates, renting remains notably the most cost effective than home ownership. So this chart, I would be, if I went and spent some time and was able to find the latest one, I would bet this chart is even showing even more bullish trends because the Fed cut interest rates in September, the first rate cut, 50 basis points. And there was a short window of activity where it was actually interest rates actually dropped for both commercial and residential. And then the treasuries took off and they just skyrocketed, right? So it's actually interest rates today for residential homes are actually higher than they were in Q3 of 2024. Right. So essentially the cost of owning a home, especially if you're a first-time home buyer, is very, very hard. And even if you're not a first-time home buyer, I like to joke with my wife that we're never moving because we have like a 2.75% interest rate. I would rather find a creative way to add on to my home or, spend money renovating our home, gutting it, doing all over inside versus going and putting a new down payment on a house that's probably smaller that has double the mortgage that I'm paying now. It just doesn't make financial sense, right? So, and a lot of people that live in homes are in the same situation. They might want to move, but the numbers just don't make sense for your mortgage to go up 75 to 100% just to move somewhere. Just doesn't make good financial sense for anybody, right? So this is really important to note and why we expect strong rent growth throughout the nation is the cost of ownership of homes is not expected to drop in 2025. So it says here, this is from Redfin, which I'm sure a lot of people know. They're a competitor to Zillow. U.S. is adding renter households faster than homeowner households, right? So you'll see here in red, renter households year-over-year growth, and then homeowner households. So this is from 2024 data from Q2 2024. But again, if I were to go pull the latest data, this chart has not changed much. We're seeing way more renters than we are people that actually own a home. So again, just a trend that is not great if you're a home buyer, but it's great if you own rental real estate, whether it's single family real estate or ideally commercial real estate. And this is a comment here because I want to dive right in and talk a little bit about the Houston market. Then we're going to talk about our overall sentiment and leave some time for Q&A at the end. This is a comment from Danny Rice, the president of Colliers, which is, again, another big multifamily provider. They both provide deals, right? They do investment sales. They can do debt and equity, and they do a lot of market research as well. So they're good friends of ours over at Colliers. So this is from Danny Rice, the president. His statement on the Houston market, this was on their opening release. They just came out a few weeks ago. A focus on Class A product was the main driver for multifamily tenants, garnering a 25% increase in absorption in 2024 compared to the previous year. So there's really strong demand for Class A assets in Houston. Construction activity has decreased by over 40% during the year, while occupancy levels for multifamily projects remain comparable or better than the previous year, allowing tenants to absorb the heavy supply of new product brought to the market over the past 48 months. So what he's saying is, even though we've had a lot of product delivered, we talked about that chart of deliveries from last year. If I showed you a chart from the last couple of years, you would see a record amount of deliveries have been made in the last 2 years since 2021, since rates were so cheap. Those units have gotten absorbed, right? And people are demanding quality assets, Class A and Class B assets, because they can't afford to buy a home. So really exciting to see this type of comment and statement put out by the president. And let's look at some of the data that was in that report as well, too. So we've been talking about deliveries a lot. We talked about national deliveries, right? But let's talk a little bit about Houston here again. So looking at historic comparison. So on this chart, you'll see a quarter four here. Let me pull out my marker here. You'll see quarter four here on the first color. Let me change my color if that works. Not seeing it. Okay. So quarter four here. Let me pull pencil color yellow. There we go. So this is Q4 right here. This is Q3 right here from 2024, and then we've got Q4 from 2024. So this is Q4 2023. So we are seeing total inventory, right? Existing units, new supply. This is really what I want to focus on. So obviously, as they're building, this number is going to go up, right? They're building more units, the number is going to go up. But look at the delivery. So in Q4 of 2023, we had 6,000 units delivered, almost 6,100. 1 year later, right, in Q3, almost a year later, in Q3 of 2024, it dropped to 4,900. And by year over year, so Q4, 1 year later from 2023, this number dropped from 6,100 to 2,066. So a massive drop off in the amount of deliveries, right? Less and less new product hitting the market. And that trend is expected to continue in 2025, right? And you'll see here, again, we've already been talking about this. We talked about how strong 2024 is. Even though we only had 2,000 units delivered in Q4, 3,500 were absorbed. So again, positive net absorption, all a really good sign here, right? You can see the occupancy has remained relatively stable, which is always a really strong bullish sign for a market. When you have a lot of units being delivered, it is not uncommon to actually see occupancy go down, right? Because if there's way more options, it's really hard for me to maintain my occupancy, right? So we've seen a stabilization in occupancy despite all the units being delivered, which again is really, really strong. And we've seen a 10 basis point increase from 2023 Q4 to Q4 2024. You'll see here also, again, what I've been highlighting across the nation is also happening in Houston. We've seen a massive amount of drops in units under construction, right? So in Q4 2023, we had 23,000 units under construction. 1 year later in Q4, we had 10,000 less, right under 10,000 less, right? 13,000. And you'll see here, because less units are coming online, but we're still seeing really strong absorption, we've seen positive rent growth compared to Q4 2023. Now, it's not as strong as Q3 2024, but you always expect rents to soften a little bit around the holiday time. Q4, again, is a really hard time to rent units. People don't like to move. So there's always a little bit of concessions, a little bit of rent drops. And we saw that in the previous chart a few charts ago with the rent growth, right? So year over year, compared to Q4 2023, we saw about a $9 increase, right, between these two which is, again, is a really positive sign. Excuse my mouse handwriting here. So let's recap over here. Houston's overall occupancy rate rose by 20 basis points from the prior quarter, and is up 10 basis points year over year. The overall average effective monthly rents contracted from 1274 to 1285, which we just highlighted here, quarter over quarter, but finished the year marginally up from Q4 2023. Class A average monthly rents decreased marginally, both quarterly and annually, to 1731 per unit, while occupancy rose 190 basis points, which is 1.9%, year over year to 84.1%. So again, overall, really strong indicators here in the Houston market. Also, talking a little bit about cap rates. And if you're a real estate investor, cap rates are super important. Where is Houston compared to Texas, and where is Houston compared to the rest of the U.S.? This is Q4 data, so this is the latest and greatest data. Houston's multifamily average cap rates decreased by 10 basis points to 5.7 during the fourth quarter. So remember, a decreasing cap rate is actually a good thing. If your cap rate is going down, it means your value is going up. And if it's going up, it means your value is going down, right? So over the same period, both US and Texas average cap rates remain unchanged at 5.6%. On an annual basis, Houston's average cap rate increased from 5.7 to 5.7 from 5.2. So the cap rate started the year at 5.2 and it grew to 5.7, right? We don't want increasing cap rates. We want them to either stay the same or go down. But again, last year, very challenging year with a lot of bad economic data, and also really, really hard when it comes to an inflation still being really strong. And it's really restrictive when it comes to transacting. There's not as much demand for investment real estate as there was, say, several years ago. So it's not surprising to see that cap rates increased, right? The state's cap rate climbed as well. So that wasn't just a Houston thing. The state's cap rate went from 5.2 to 5.6, and the country, so the United States, went from 5.3 to 5.6. So Houston's pretty in line with the state, and the nation's average is 5.6. Houston's is 5.7, so just 10 basis points higher. It's about the same. And then we saw Texas here at 5.6. So just really good information to see. And we're confident here looking at this chart. I think we're going to hit on the tail end of this. I think if I had to guess, we're starting to see a cap rate stabilize. So I think, Q1, Q2, we're going to see a relatively flat line. And then I think Q3, Q4, you're going to start seeing the chart dive like this. So it'll be really interesting to see, hopefully I don't eat my words there. I don't have a crystal ball, but I think over the next couple quarters, we'll see some relatively flat or stable cap rates, which means values won't change too much. Now, if inflation upticks and they start increasing interest rates, obviously that could be a problem. But I don't see that happening. I think inflation is going to stay relatively the same. We're going to start to see a decrease in inflation, and we should see an uptick in activity because a lot of investors have been on the sideline, and there's all this bullish data that I'm talking about. I think going into Q3 and Q4 of 2025, we will start to see cap rate compression. It won't fall off a cliff. It's not going to go like this. But we will start to see a flattening and then a slight modest decrease, and then we'll get to some point in 2026, 2027, where you'll start to see another correction, right? So that's just how the market is. It's very cyclical. It just takes time, right? So you're looking at, going into 2019, which is the year before COVID, right? Cap rates were already decreasing. Then COVID hit. They kind of stabilized for a little bit. They were dropping still because money became free. And then money became free and cap rates obviously got super compressed. That lasted until mid-2022. The Feds announced they started raising interest rates, I believe, March or April of 22. And that's when cap rates started to increase. And then the Feds started cutting interest rates Q3 of 2024. The first rate cut was in September of 24, right? So that's Q3, which is why you see this sort of flattening of the curve, so to speak. And I think you'll see this flattening here. And then I think once they start announcing more rate cuts and the treasuries stabilize, as long as we don't have some sort of crazy war or crazy inflation uptick, I think you're going to start to see cap rates decrease, which again means our values are going to go up. So now is the time to buy, in my opinion, where cap rates are flat. They're not increasing. We can buy now and sell for a lower cap rate, which means our dollars stretch farther. We make more money. So all really good signs as far as looking at the charts here in Houston. Now, this is another great chart. I want to highlight some investor sentiment. What are we seeing when it comes to investors in the multifamily space or just in the commercial real estate space? So this is multifamily sales activity and cap rates. You'll see here, again, what I was highlighting a minute ago, as cap rates compress, right? So you got your cap rates here on the red line. we saw activity spike, right? That was in 2021, 2022. And then, of course, cap rates have been increasing since then. Activity goes down, right? Common sense. But what I believe personally is going to happen, and some other economists as well, and this is from our friends over at Headway Capital, they believe the same thing I do. I think we're going to start seeing cap rates decline going into 2025, 2026, which means, again, when the cap rates decline, activity picks up. I think we're going to start seeing an uptick in activity in multifamily real estate. I think it's going to take the first half of this year to be still a little slow. We're still looking for deals. We're not sitting on the sidelines, but I think you won't start to see a lot of uptick in activity until the second half of this year. And going into 2026 is when I expect there to be, I'll call it a slight boom. It's not going to be a 2021 boom, but there will be a lot of activity compared to the past few years. So again, investor sentiment still really, really strong going into the year for multifamily real estate. And again, this is something I've already highlighted. This is from NMHC, right? So again, I already highlighted this a couple minutes ago, but as interest rates go up, obviously apartment investor sentiment goes down. So looking at this is really interesting to see, but the latest data from January 2025 is investor sentiment is actually down a little bit. And that's partly because the treasuries have been so volatile. So going into Q3 of last year, October 2024, you saw sentiment here shoot up. Investors were super excited. This is all investors, whether you're buying hotels or apartments. Everybody's like, oh my God, they're cutting interest rates. This is going to be amazing. I'm excited. Let's go. Let's go out there and buy some deals, right? And then what happened? We talked already about the treasuries, right? We talked about, holy cow, the treasuries are actually going up. They're not coming down. It's going to take a while for that to happen. So investor sentiment has went down a little bit, right? But still, overall, we're very bullish. We want to buy when things are on sale, and we also want to buy, my opinion, when it's not super competitive. I don't want to be bidding against 20 other people. I want to buy things at a discount. I want to buy when there's less buyers, and I want to sell when there's more buyers. So we're not necessarily as worried about everybody else's sentiment, but it is really interesting to see how the treasuries can impact investor sentiment going into the year. A big thing for 2025 as we wrap up here and go into Q&A, one of the last slides here, is looking at loan maturities, right? So this is really important to see because loan maturities affect market supply as well, right? If a lot of loans get matured in 2025, we could see a lot of deals on the market. I mean, this is again from our friends over at Gray. This is a wave of multifamily loans are coming due in 2025. Obviously, this happened in 2023 as well, but loan maturities in 2025 could be a powerful catalyst for sales activity in the multifamily market. So a lot of people bought deals in 2022. They usually buy them on 3-year terms, right? It is now time to do one of two things: refinance or sell, right? Or again, renegotiate your terms with your lender, try to kick the can down the road. So along with research from the New York Federal Reserve suggesting that loan workouts and extensions are less appropriate in 2025 than they were in 2023, forecasts for the Fed fund rate and 10-year Treasury yields point to a continued elevated interest rate environment. So rates are going to still stay high for the first half of the year, putting more pressure on borrowers facing maturities. This is key to highlight because two of the deals that we acquired last year were exactly what this slide is talking about. Borrowers that bought a deal, they got to a point where they couldn't afford the loan anymore because rates went up so fast, and we had to come in and we were able to acquire those assets at a substantial discount compared to what they were previously transacted for, right? So this chart's really telling, and this is from CoStar, on the amount of maturing loans coming due in 2025 with a massive peak. You'll see here. These numbers are in the billions, right? So this isn't 500, this isn't 5 million, this is 5 billion of loans. This is all assets. This isn't just multifamily, right? 5 billion plus of assets due. And what is this? August, September. This is October of 2025, right? So I think again, Q3, these deals that are maturing in October of this year, they're going to hit the market 90 days, maybe 120 days before, right? So that's about 3 months. So if you go back 3 months, right? So go back to August, go back to July, again, summertime, right around here. I think you're going to see a lot of deals that are somewhere in this bubble right here, right? That need to hit the market. So you're going to see some discounted real estate, and I'm personally really excited about that going into the year. Rate cut probability. So we'll wrap up with this and go into Q&A. A lot of people are curious what the Fed is forecasting when it comes to rate cut. So this is a chart that you can actually find on the Fed's website. There is a pretty high maturity the pretty high likelihood that we'll see rate cuts next year, but they're not as positive as they were previously. So going in a few months ago, if you would have done some research on this, people were forecasting 4 or 5 potential rate cuts going into 2025. That number has come down to about 2 on average, depending on where you're looking. And you'll see here, the other important thing to tell is there really isn't a probability of a rate cut, a substantial probability of a rate cut until you get to June of this year. Again, and this keeps sticking to my point why I think the summertime is where things are going to pop and things are going to get more exciting when it comes to real estate, right? So these are Fed meetings. These are when the Fed announces rate cuts and what they plan on doing. The first one is coming up here in 6 days. I don't think they're going to do anything. There's a 99% chance that they do absolutely nothing. So this is the current Fed funds rates. It always runs in a range. Right now it is 4.25 to 4.5. There's a 99.5% chance they don't do anything. There's a 71% chance they don't do anything, and it kind of drops from there, right? You'll see this here. But you'll see here the highest likelihood for it to go down. So we want Fed fund rates to get cut. So market is forecasting there's a 44% chance that the rates would go down from 4.25 to 4.5 to 4.00 to 4.25. So 4% to 4.25. So June this year is when most people are forecasting that we will see the next rate cut. A lot of people think the Fed's going to take a wait and see approach for the next 6 months. We have a new president in town. He's kind of cleaning up some things that he feels like needs to be changed from the previous regime. There's still a lot of inflation isn't slowing as fast. It's still slow. It's compared to the 9% we saw 18 months ago, but it's not dropping as fast. They've cut interest rates already 1% or 100 basis points since September. We had a 50 basis point cut and 225 basis point cuts equaling 1%. They're going to take a wait and see approach, because if they let their foot off the gas or let their foot off the brakes too fast, we could see a rising uptick in inflation, because these rate changes, whether it's a cut, right, a rate cut or rate increase, they take time to ripple throughout the market, right? Sure, the S&P 500 and the treasuries will kind of react pretty quickly. But really, you don't feel the effect on the economy when it comes to GDP and the producer price index and what it takes to sort of manufacture things for several months, often 12 months or more, right? So they can't let their foot off the brake too fast. If they do that, they could risk an uptick in inflation. So most people are forecasting that we just had a rate cut in December. They're going to wait 6 months. They're not going to do anything for 6 months, and the next rate cut will be a 25 basis point cut, so a small cut in the June meeting. I don't have a crystal ball, but we'll see what happens. And I've already talked a little bit about this, but deliveries and vacancy. So I want to just kind of end this up because we're getting at the top of the hour here. Will multifamily thrive in 2025? We think it will, and here's why. So I'll kind of recap this. The inauguration of President Trump is bullish for real estate and business conditions, right? A lot of people are talking about 100% bonus depreciation come back. This year in 2025, that number is 40%. It has dropped. It went from 100 to 80. Last year was 60. This year is 40%. A lot of people are hoping that he brings back year one, 100% bonus depreciation. We'll see what happens, but a lot of people are bullish because of that. Strong economic data like job growth, we talked about that, unemployment, and the increase the likelihood of a soft landing, right? It increases the likelihood that even if we have a recession, it will be very, very mild. High housing demand and soaring cost of home ownership compared to renting will help continue the historic demand for apartments. We talked a lot about supply and demand today. And a slowdown in permitting, of course, for new construction assets will lead to an increase in demand and valuations for 2026 and beyond. Again, if they're slowing down building, that's going to have an impact in 1 year, 2 year, 3 year, when there's not as many deals coming online, because it takes 3 years to build a new construction apartment. If they slow down and they hit a brick wall in 2025, well, they're not going to be able to deliver new units at a fast pace until at the very earliest 2027, 2028. That means we're going to get this little sweet window of about 3 years where a lot of assets are increasing in value because there's not as many deliveries coming online. We like that. The Fed is going to take a wait and see approach to rate cuts, but higher rates for longer could lead to price decreases, right? Because there may be more distressed deals. So if deals are sitting on the market and they can't sell, they could go into special servicing or pre-foreclosure, and we could end up buying some deals at no value or less than no value, just like we did with Shadow Creek and Ashford Park last year, and we're excited about that. So due to all these factors, we forecast, including rent growth, we're very bullish, right? We're very bullish on the fact that the multifamily market is going to be very, very strong this year, even though We think it'll be a little slow the first couple quarters. I think there's going to be a lot of activity, and we already have a pretty full pipeline. A lot of deals we're looking at on the market right now. I was looking at our tracker the other day. We're looking at a good 10, 15 deals already just between Houston and Dallas, and underwriting those deals, analyzing those deals, seeing if they make sense for us. So we're very bullish, especially when we see strong rent growth. So that's our final statement. We believe that 2025 is going to be a great year to invest. We talked about the fact that the economy is still pretty strong, even though inflation hasn't necessarily slowed as fast. It's still above that 2% goal, but it is way below where it was several years ago. We still see strong GDP growth. Retail sales were still really strong for this past holiday season. And as long as unemployment stays in check and people are able to keep their jobs, we're going to be able to continue to push rent growth. It's really expensive to still buy a house. Interest rates are still really high. We still forecast there's going to be really strong demand for the multifamily space in 2025. So we're excited about this year. So if you're on this webinar and you are not a part of our investor club, I would invite you to sign up. That's how you get access to our deal, how you get access to our events. I also want to invite you, if you're waiting to invest in a multifamily deal, we do have an income fund that we have here for our investors here at Headway. It's for accredited investors only, and it could pay 8% for a $100,000 investment. And this is a hard money fund. It is semi-liquid, so you can invest into this fund. You get an 8% annualized return, and it is semi-liquid, so we can repay you back your money within 90 days if you need it back. This is a great place to park your cash while you're waiting for one of our multifamily deals. You'll see here the returns on your screen. It does have a $25,000 minimum, so you can get a 6% for $25,000. Sorry, anything less than $100,000. Anything over $100,000 does pay 8%. So again, this is a great place to park your cash while you're waiting for the next opportunity. If you don't feel comfortable with the equities market and the treasuries market, reach out to me. You can scan this QR code here or just shoot me an email, Brian@headwaycapital.us, and I can share more info about how you can invest in the income fund if you are an accredited investor. So with all that being said, let's go to Q&A. Phone numbers on the screen again. If you want these slides, text me and QR code to schedule a call here. And then I want to say thank you to everyone for attending tonight. We're right past the hour point, so I'll take a couple of questions. I do see we have quite a number, but I'll answer as many as I can here. Which multifamily asset class do you see the most growth and demand? I personally think that the A and B class space is going to see the most growth and demand. And part of that is going to be because so many people want to buy a home but cannot afford to. Those residents that are still technically good buyers, they just don't think it makes financial sense to buy a house right now. Or maybe they don't qualify because of the rates being so high, but under normal market conditions, they would qualify. They're not going to go live in a C-class product, right? They're not going to live in that type of product that has, $1,000 a month rents. They're going to go live in like B plus A class product. I'm not talking about luxury high rises, right? I'm just talking about good, still quality A class product. A class product is going to be anything that's built, 2000 and up. B class product is going to be like your 1980s, 1990s and up, particularly 1990s if you can. So that's really where a lot of the demand and the growth is going to be, in my opinion. Now, it will get harder to push rents in the A-class sector because of the amount of supply that we've seen the last couple of years, but those units are going to all get absorbed. The A-class units typically have slightly lower cash flow compared to your C and your B-class units, but they have higher long-term equity growth, which is really what a lot of investors are looking for. So great questions. Terrence Cantwell asks, how can more units be absorbed than units delivered? That has to do with the amount of units that were left online from, say, the previous year, right? Or if you include B and C class products, right? So if they build 10,000 units and 12,000 get absorbed, that just means that maybe 2,000 units got absorbed from the previous year that didn't get absorbed, right? So if there's negative absorption, that's how that happens. So let's say, for example, I build 10,000 units, right? But only 8 get absorbed. That means there's 2,000 units on the market that never got absorbed. Well, if the calendar year turns and then those units get absorbed and then some, that's how you have more absorption than you do have actually deliveries. So hopefully that actually makes sense. Thank you again. See you tomorrow. Awesome. See you tomorrow, Philip. Great. Last question here before we wrap up. We're past the hour. David, since rates have not come down as rapidly or as much as predicted last year, do you think this makes 2025 an even better opportunity with a long period of distress for operators to buy at a discount? Yes, I do think that there's going to be more opportunities to buy at a discount this year. I still think it will be tricky to raise capital, right? Investors are still a little nervous. They see a lot of the headlines and maybe think things aren't as bullish as some people think. But we have to remember, I always try to follow the old Warren Buffett quote. When investors are nervous, when investors are greedy, you should be scared. And when investors are scared, you should be greedy. So if a lot of the people are nervous and kind of hesitant, but things are on sale, things are 20, 30, 40% discounted compared to where they were several years ago, even though it's sometimes hard to psychologically talk yourself into buying something because you're reading the headlines. I want to buy when things are on sale. I don't want to buy at the top of the market and try to sell at the next top of the market. I want to buy when the market's down. I want to buy at a discount. I want to buy when things are affordable. And then I want to sell when the market demand picks up, right? So that's the psychology you want to put yourself in is if you're getting FOMO and you're getting fear of missing out because grandma at Thanksgiving is talking about investing in multifamily, that probably means that the market is very hot. It probably means you're buying at the top, right? It's kind of like crypto or any type of other stock, right? If everyone's talking about it, you're probably too late, right? Right now, people aren't all talking about multifamily because of the sort of pressure it's felt the last couple of years. Well, that's when I want to buy when nobody else is looking, when things are on sale. So great question, David. With all that being said, we're right past the hour mark. I want to say thank you to everyone for attending. Really excited about 2025. If you haven't reached out to us to schedule a call, send us an email, investor@headwaycapital.us, or email me directly, brian@headwaycapital.us. If you want these slides, send us a text here. Would love to schedule a call with you. If you're interested in the income fund, same thing, reach out. And then again, if you want to join us for our case study that we're having tomorrow, I have the link in the chat. We'll love to see you there. Hope everyone has a great evening. Take care.